What are alternatives to short-term options strategies? If you are curious about what options exist beyond short-term strategies in options trading, you are in the right place. Let's break down some alternatives that can help you manage risk and reward more effectively. One option is the vertical spread. This strategy involves buying and selling options of the same type, either calls or puts, with different strike prices but the same expiration date. For example, a bull call spread entails buying a lower strike call and selling a higher strike call. This limits both your potential profit and loss, making it less risky than simply buying or selling short-term options. Another alternative is the diagonal spread. This strategy combines different strike prices and expiration dates. You would buy a longer-term option while selling a shorter-term option. This approach allows you to benefit from directional moves and time decay, giving you more flexibility than sticking strictly to short-term options. Next, consider the covered call strategy. This involves owning the underlying stock and selling call options against it. By doing this, you generate income from the premiums. This strategy works best when you expect the stock to remain just flat or rise slightly, and it is generally less risky than selling naked short calls. You might also want to look into protective puts. This strategy involves buying a put option on a stock you already own. It provides downside protection and limits your losses if the stock price falls, acting as a form of insurance while still allowing for upside potential. Another option is the collar strategy. This combines a protective put with a covered call. The put option limits your downside risk, while the call sale offsets the cost of the put by generating premium income. This strategy is useful when you hold a stock and have a neutral to slightly bullish outlook. Short puts are another alternative. By selling puts, you generate premium income, but you also take on the obligation to buy the stock if it falls below the strike price. This strategy profits if the stock price remains above the strike, but it carries risk if the stock declines significantly. Lastly, consider short straddles and strangles. These strategies involve selling both calls and puts at or near the current stock price for a straddle or at different strikes for a strangle. They aim to profit from low volatility, expecting the stock to stay within a certain range. However, these strategies can carry significant risk if the stock moves sharply. These alternatives provide different risk and reward profiles compared to typical short-term options trading. Each strategy can be tailored to your market outlook, risk tolerance, and investment goals. By understanding these options, you can make more informed decisions in your trading journey.